Futures and hedging, understanding contracts and risk management strategies. Agenda overview, basics of futures contracts, understanding hedging, types of hedges, short hedge and long hedge, managing positions, options in hedging, hedge ratio. Definition and purpose of futures contracts. What is a futures contract? A futures contract is a standardized legal agreement to buy or sell an asset at a predetermined price and date. Purpose of hedging. Futures contracts are primarily used to hedge against fluctuations in the underlying asset, providing financial protection. Price discovery mechanism. These contracts facilitate price discovery for assets, helping market participants gauge future price expectations. Types of futures contracts. Commodity futures. Commodity futures involve contracts for physical goods like agriculture products or metals, allowing producers and consumers to hedge against price changes. Financial futures. Financial futures are contracts based on financial instruments such as currencies, interest rates, or treasury bonds, used by traders for speculation or hedging. Index futures. Index futures are based on stock market indices, allowing investors to speculate on market movements without owning the underlying stocks. How futures markets operate. Trading contracts. Futures markets enable buyers and sellers to trade contracts for future delivery of assets, facilitating price discovery. Supply and demand dynamics. Price movements in futures markets are influenced by the dynamics of supply and demand, impacting trader decisions. Market outlook participation. Traders engage in futures markets based on their outlook on market conditions, including economic forecasts and trends. Definition and purpose of hedging. Understanding hedging. Hedging is a financial strategy aimed at reducing potential losses by taking an offsetting position in a related security. Risk mitigation. The primary purpose of hedging is to protect investments from unexpected market fluctuations and reduce exposure to price volatility. Profit protection. Hedging helps in safeguarding profits by minimizing the impact of adverse market movements on investment returns. Difference between hedging and speculation. Purpose of hedging. Hedging is used to reduce potential losses by taking on opposite position in a related asset, stabilizing returns. Objective of speculation. Speculation involves taking calculated risks in hopes of significant profits from price fluctuations in assets. Risk and reward. Hedging minimizes risk while speculation embraces it for the potential of high returns, reflecting distinct trading philosophies. Examples of hedging in various industries. Hedging in agriculture. Farmers use hedging strategies to mitigate risks associated with falling commodity prices, ensuring financial stability. Hedging in energy sector. The energy industry employs hedging to protect against price volatility in oil and gas markets, stabilizing operations. Hedging in finance. Financial institutions utilize hedging techniques to reduce exposure to market fluctuations and protect investments. Hedging fuel costs. Airlines hedge against fuel prices to manage operational costs and maintain profitability. Short hedge. Definition of short hedge. A short hedge is a strategy used to protect against price declines by selling futures contracts. Purpose of short hedge. Producers frequently use short hedges to lock in selling prices, thereby reducing price risk for their goods. Market application. Short hedges are commonly applied in various markets where price fluctuations can significantly affect producers. Long hedge. Definition of long hedge. Long hedge is a risk management strategy that involves buying futures contracts to protect against rising prices. Purpose of long hedge. This strategy is primarily used by buyers who aim to secure current prices for their future purchases, minimizing the risk of price fluctuations. Futures contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price at a specified future date, often used in hedging strategies. Hedging strategies with long underlying and short underlying. Risk management. Hedging strategies are essential for managing risks in trading by balancing potential losses with gains. Long underlying assets. Long underlying assets involve purchasing securities with the expectation that their value will increase over time. Short underlying assets. Short underlying assets involve selling securities borrowed from another party, anticipating a decline in value. Closing out positions. Definition of closing out. Closing out positions refers to the process of selling or buying futures contracts to either source profits or minimize losses. Timing and strategy. Effective timing and strategy are crucial when closing out positions to manage risk and capitalize on market opportunities. Risk management. Understanding risk management principles is essential for deciding when and how to close positions in futures trading. Taking opposite position in futures. Risk management strategy. Taking an opposite position serves as a risk management strategy, helping traders mitigate potential losses. Counterbalance existing positions. This strategy allows traders to counterbalance their existing positions, creating a more stable investment approach. Protection against market fluctuations. Utilizing an opposite position helps protect against market fluctuations and unexpected price changes. Impact of falling and rising prices. Hedging strategies. Hedging strategies are essential for traders to mitigate risks associated with price fluctuations in markets. Consequences of price movements. Falling and rising prices can significantly impact a trader's position, affecting overall profitability and risk exposure. Market dynamics. Understanding market dynamics is crucial for traders to adjust their strategies effectively in response to price changes. Buying and selling futures. Fundamentals of futures contracts. Futures contracts are agreements to buy or sell an asset at a predetermined price at a specified time in the future, crucial for traders. Trading strategies. Buying and selling futures are essential components of various trading strategies, enabling traders to speculate and manage risk effectively. Hedging implications. These transactions allow investors to hedge against price fluctuations in the underlying asset, protecting their investments. Using options in hedging. Sophisticated hedging strategies. Integrating options with futures contracts allows traders to develop advanced hedging strategies that manage risk effectively. Protecting against price movements. Options provide traders the ability to protect their investments from unfavorable price movements in the market, offering a safety net. Retaining potential upside. Using options allows traders to hedge their positions while keeping the opportunity to benefit from price increases. Differences between futures and options. Obligations. Futures contracts require the buyer to purchase and the seller to sell at expiration, creating a binding obligation. Risk profiles. Options offer the right but not the obligation to buy or sell, leading to different risk profiles compared to futures. Strategic use. Futures are often used for hedging against price changes, while options provide flexibility in risk management strategies. Hedge ratio. Understanding hedge ratio. The hedge ratio measures the proportionate value of a hedge compared to its underlying asset, guiding effective risk management. Importance of hedge ratio. Calculating the hedge ratio is crucial for minimizing potential losses and enhancing investment strategies in volatile markets. Understanding beta in hedging. Definition of beta. Beta quantifies the volatility of an asset relative to the overall market, offering insights into risk management. Importance in hedging. Understanding beta is essential for determining an appropriate hedge ratio. which helps in risk mitigation. Risk management. Utilizing data effectively allows investors to manage risk more proficiently by aligning their portfolio's volatility with market movements. Conclusion. Importance of futures contracts. Futures contracts are essential tools for managing price risk in volatile markets, allowing traders to lock in prices. Hedging strategies. Hedging strategies help traders mitigate potential losses by offsetting risk in their investment portfolios. Risk management in trading. Effective risk management practices are crucial for traders to navigate volatile markets and protect their investments. Thank you.